it's funny how a dated Brent market that is, so disproportionately impactful for the world's crude oil pricing can be net bearish, but still prices go higher because of financial money, because of Brent spreads, because of the sheer weight of that speculative drive from the Red Sea. So I think now we've got to say, can it all filter through and continue with momentum upwards, or the North Sea guys, for example, have they got it wrong? Hi again, welcome to another episode of World of Oil Derivatives. This is a market episode and I'm joined with Martha Dowding and Vincent Wu in Singapore remotely. Just wanted to start off by saying again, thanks so much for your support. We're seeing a lot more subscriptions, views and downloads. Please continue to do so and subscribe to this podcast. It really does help. So viewers who are listening but aren't subscribing on YouTube in particular, that would be a great help. Just a reminder there, thank you. So jumping straight into it, Martha, we've got to, we haven't prepared as much for this one because there's been a lot going on, but in a good way, right? There's a lot to talk about. We've finally broken out above 80 on Brent, and there's just seems to be moving, right? So we can give a quick summary on that side of things.
Yeah, I mean, the long and short of it is that it has been a bullish week last week. We've seen the second week-on-week gain in a row, so that's great news for some. Spent most of the week last week above $80 a barrel, and we've just slid down to about 82.35 at the moment. Around those handles. So it looks like they've kind of corrected a little down from, I think we were touching like 84 earlier today.
But it is a big deal, right? Because it's stuck in a range and the range was getting tighter and tighter. We actually had a trade suggestion for being, selling the volatility, expecting that range to be narrow. And it might only be, $3 or $4 above kind of the homeostasis level for the last few weeks, but that's sometimes enough, right? And there'll be a lot of technical traders definitely being interested in this. And what can we pinpoint and not exactly say exactly why it happened, because you can never know, but what do we think of the big drivers?
Well, all eyes are on the geopolitical risk premiums again, everyone's favourite three words, coming out of the Middle East, the Houthi attacks, the drone strikes by the US and the UK, and just that kind of like further developing. And also we're looking at good economic news out of the US and promising news from China. So although the strong US news does like strengthen the dollar, this has really brought a further leap of confidence from bullish investors, with the GDP release last week being pretty significantly stronger than expected. So
for last Friday, we got it for the Tuesday, and actually what Brent's, if anything, managed money was kind of being bearish, right, in terms of its positioning. So it must have been a very recent thing. So I guess we can say quite comfortably that we should expect in the next report to see a big increase in managed money buying, short-term, like fast money buying, because it happened kind of in those 3 days, the switch at least. And what happened in those 3 days was an escalation right at the Red Sea. Yes. There was no real new information other than that, because the North Sea strength, I think this is physical, that was already in the market and known about and had moved kind of the key differentials. It does feel very much like a headline play, and it was just enough buying and enough of the tension to follow into like a real move. Is that fair to say? Yeah, I think the only other geopolitical risk premium news would be the Russian refineries, but I don't think that would be too like bullish crude. Yeah. And EIA stats, to be fair, as well. Yeah, that was really a pretty impressive draw. So there was a draw of 9.23 million barrels versus the just over 2 million forecast. And Cushing storage saw its third weekly decrease, and it fell by 2 million barrels. So pretty impressive. And also there was the announcement that because of the deep freeze in the US, the crude production fell by 1 million barrels a day as a consequence of this, with refinery utilization down to 7%. So. Okay, so the refinery utilization down 7%, that's a huge fall, and that's a huge fall in consumption of crude off the back of it. Yet we still drew a hell of a lot. So this is only really one thing, right? It's two things. It's either a lack of production from the US or it's an increase in exports. But with the whole situation, the freight situation, it's probably much more indicative of a fall in production.
Rig count up too.
Count up too,
but that's lagged, I guess.
Yeah, but I'm just making the point that actually is quite unexpectedly, like quite serious impact on the physical market. Like you can't say it's not. So it does turn out, all the things coming on, the Texas freeze, the Red Sea situation, and actually, post destocking at the end of the year, refinery buying, has all amalgamated into like a genuinely meaningful distortion in the market towards the upside. And so it all seems quite logical that we are rallying. I mean, for what it's worth, I sat down on the Dated Brent desk the other day, just check it out, and there is quite a lot of selling. Like people are looking at this. It seems that we are pretty overdone on the physical differentials, and we've had the spike that was off the back of the things that we're saying. And there seems to be quite a lot of people getting in short. But it's funny how a Dated Brent market that is so disproportionately impactful for the world's crude oil pricing can be net bearish, but still prices go higher because of financial money, because of Brent spreads, because of the sheer weight of that speculative drive from the Red Sea. So I think now we've got to say, can it all filter through and continue with momentum upwards, or the North Sea guys, for example, have they got it wrong? Like are they shorting into this market and actually they're not really paying enough attention? Or I think probably more likely, and this is obviously the disadvantage of being a retail trader investor, is the things that we are seeing and the reasons for some of the more bullish rallies in Dated Brent differentials and time spreads was because they knew this stuff ahead of time, right? This information's always lagged. It's hard enough to get a day-1 supply and demand situation figured out, let alone forward looking. So these guys get their indications from refineries. One trader was telling me we've got a refiner who wants oil tomorrow, loading tomorrow, and that's very, very rare, right? Usually it's at least a week forward, 2 weeks forward. So when you see the physical market that's playing out kind of 30 days forward, that's real transactions that are being used to price these like futures, but they're also the real physical market. So it's actually a lot more beneficial to look into that forward market to see what's going on, rather than say, oh, what are the stats today on the result of those things? It's already happened. So that would be my take, speculatively, that you could actually justify a lot of the professional buying early on in the year due to all that, rather than saying now it should be bullish. You see what I mean? Lead lag situation. Yeah. But then lead lag, you can't discount that there's a lead lag, but if you don't kind of educate the financial money on that,
it's just the reaction, and it's just like cyclical.
Exactly. And then actually, because they're so powerful with their volume, they can overwhelm the professional market shorts.
Yeah, definitely.
And so it's like a weird, like they're actually, how you get like short sellers in equities who they'll short a stock like Tesla or something, and then the fund managers will go out in the press and actually explain in like white papers and detail like exactly why you should be shorting the stock and exactly why it's so bad, because they want everyone to sell it. Do you see what I mean?
Yeah.
So that's actually what you need to do as someone who has this information to put on a short. It's, this is all public available information. This is the way this is how our take on it. But if you have that lead lag, and that can sometimes work massively against you.
Yeah, definitely.
You can see it as an early advantage, but you can also see it as, if they don't get it, I could be screwed over for quotation marks, no reason. But the reason is because the financial money is bigger than your money. Yeah. Do you see what I mean? Vincent's, have you got anything to add to what we're saying?
Looking at the Dated Brent market, and to follow on with what you guys are saying, so looking at the DFLs, which is the Dated Brent versus Brent swaps, essentially you could say that as the professional money versus the financial money in oil trading. Looking at the forward curve, especially interesting, especially when you look at February, around 46 cents per barrel, but compare that with March and April, 5 cents and 12 cents, indicating very strong structure, especially in the prompt February contract, which, as you mentioned, Greg, it's very much indication of tightness in the spot market. Yet when you go down the curve, looking at May, June, July, August, September, that's been steadily rising to around 30 cent per barrel levels these days, indicating potentially more hedge buying, which actually didn't really increase over the last 2 weeks, but over the past week, that has really seen a slow but very consistent rally upwards, potentially indication of long-term refinery hedging. And as well as that, on our commitment with traders dashboard, we've been seeing more Q2 buying flows down there as well. So it's interesting to see the kinks in the curve, where usually you expect to see like a uniform backwardation or a uniform contango.
Yeah, that is a good point, actually, because refinery maintenance is a pretty big deal for these like localized contracts that are looking at localized physicals. So for the North Sea market, for it to be so inflated early on in the year, it means that you can have a more aggressive retracement when you have refinery maintenance, because it's all about the marginal barrel, right? So if you have a physical differential like plus 150, like a balanced market would be around, like, let's say minus 10, to plus 20 cents or something like that. So when it's so inflated at 150, if it goes down from 150 to $1, that's a huge move in a physical differential, a physical premium that someone's going to pay or someone's going to sell. But actually, there's no real difference, because how could $1 is still expensive, right? You're saying, how do I quantify what's expensive? A dollar is like objectively strong. So the fact that it's gone from 150 to $1, you're still saying, yeah, it's still a strong market. But for someone who entered at 150, they're getting killed, right? At one. So what I'm saying is when a market's inflated as it is right now, you have one physical barrel, like literally one physical cargo that can be offered into the North Sea complex, which then prices the futures and yada yada. That can have a huge difference. It's because the markets are always settled by the cheapest cargo, right? So someone coming in right now saying, look, refinery maintenance is around the corner. I don't need this oil in storage, or I don't need to keep buying like I've been buying. Suddenly all these offers coming out of nowhere, and it can completely reset the market. And going back to the lead lag thing we're saying, Martha, right? That's a disadvantage for like the investors. You can't necessarily see that. But then my point to you, Vincent, was you're saying Q2's been bid. Well, then you're coming out of refinery maintenance, and actually you're coming out of refinery maintenance, particularly in May for China, which has always been a hot spot for the Dated Brent market. They do a lot of exporting into China for the 40s crude, and people like to buy in May cheap because they're kind of expecting this like incremental demand increase as they come out of maintenance. So I would say a bit like gasoline. You've always said the summer gasoline versus Brent cracks are always like a safe bet. It's kind of similar for May Dated Brent. It's always kind of has that kind of cyclical nature to it. And Martha, you actually were talking last week about being bullish distillates. It's another one that's had a bit of a breakout as well as crude.
Yeah, so just going back to the geopolitical risk premium, that's basically been a huge driver in the refined products this week. Looking at different products, it's had different impacts. But so this is the European refinery margin for March. There's been a really significant increase week on week. And so it's $1.71 per barrel over the week increase. And that is even with the really significant increase in the price of Dated Brent. For those watching, I can see this graph might be a little confusing. I had some questions about it this morning. So when the Dated is going to minus, that means that it's more expensive for refiners to buy. Therefore, it's more expensive, full stop. So just if there was ever some confusion,
so stronger crude is a negative impact on the margin.
Yeah.
So the premium to Brent that we've been talking about, because that's been going up, that's been hurting the refinery's profits, basically. Yeah.
Yeah, therefore weakness in the margin has been overtaken by the strength in the products, specifically gasoline and gas oil, as that has been recently. And they both have really interesting geopolitical kind of takes to the story as well.
Okay.
First, looking at gas oil, it's been just a huge rally recently. I think it's best kind of exemplified looking at the East-West, which I'll put on my screen now. So this is the East-West. You can see it's like really, really volatile looking at the Bollinger Bands, and you see the price has just been smashed down. That's on the back of really, really strong European gas oil, and this is all due to these geopolitical issues with the attacks in Russian infrastructure of the refineries that have been happening. I mean, there's been a handful now. I think there's just been another one this morning, I think, if news sources is to be believed. And I think that we had seen a few of these in the past, but they hadn't had so much of a big impact in the market. But now it's become, it's not just like a one-off, it's become almost a trend that these things have been happening, and so the market is pretty worried about supply.
Yeah, it's a great one, because we were talking about this last week as well, about the arbitrage being open and closed. I mean, around minus 30 traditionally was definitely where you're getting into open arbitrage territory to take from Singapore, or at least Asia, into kind of east to west gas oil into Europe. Gas oil being harder to produce for European refiners, the way they're geared. So for it to get absolutely hammered like that, when it's already at a very, very low level as a differential, in other words, historically an open arbitrage, shows you just how nefarious the situation is with the Red Sea and all the situations going on there. It's genuinely impacting freight, genuinely hurting the arbitrage. So it really doesn't matter how far this level goes down if the shipping situation is not sorted out. And that is, on the one hand, quite difficult to trade if you're just looking at if you're one of those traders that looks at historical norms and wants to trade outside of those historical norms, relative value type trading, especially if you're bullish gas oil, right? You're thinking, there's probably Eastern demand there and things like that. But this is definitely a sign of a localized impact. Sorry, not a localized impact, like a genuine impact from an event impact. Because you wouldn't historically get this. So something has to be, quotation marks, wrong for it to be allowed to trade like this. So it's a very difficult one. I imagine what you'll see is when everyone's starting to really panic, you'll get some of the profit taking from traders who have been confidently shorting this, knowing that the situation is just not sorting itself out, wanting that long exposure to gas oil in Europe probably, kind of via selling the diff, and then actually starting to say, I can see it's all about, this is the problem with trading derivatives for some people. It's always about the future by definition, right? It's settled by in the prompt month by physical that's settling, at least a few weeks forward, sometimes much longer. So when you're trading month one is like month 2 physical. So it's 2 months from now, is this physical situation going to be sorted out? And at the moment, okay, you could say everyone's really scared, but in 2 months' time, a physical trader who's got a lot of experience, who's making the calls, doing the chartering, she's going to get a sense for like, it's not as bad as the price action is dictating, and actually the economics are starting to look attractive, right? Whack, this is the time. Everyone's short, everyone got stopped out, everyone's fearful. Now's the time to be greedy, and you will get an aggressive pullback. But the temptation is to say, buy what's cheap. And that can sometimes work, but obviously it's all about timing. So in a trade like this, if you want to be buying the East-West and capturing this like big like retracement, you're going to need to have confidence that the situation, in 1 to 2 months' time is going to be solved. But also you're going to want to see the beginnings of buying and a kind of leveling out on the downward volatility, because otherwise you're just catching a falling knife. Yeah. And the trick there is having the confidence that it's going to pull back aggressively. So you have to find the kind of environment of your trade, so you can say, right, as soon as I do see this buying and this consolidation of volatility, I'm not going to hesitate. I'm going to lift the first offer. I'm going to be aggressive in it, aggressive in my conviction, and then you can ride the trade. But again, the same way it gaps down, it can also gap up. And if you're not in the trade, you will miss the trade. So it's getting your entry signals really clear and objective, and just and gearing up for that. I know you didn't ask, but that was what I saw with the graph. And so, like, again, more strength in gasoline. It's been quite a good year.
Yeah, so gasoline continues to be extraordinarily well bid, I think, especially in the past week in Asia and the Sing 92 contracts particularly. We've seen MOC well bid across all of the contracts that we see trade, and refiner buying continuing in the 92 spreads, which we spoke about last week, which is quite indicative of, maybe potentially further strengths when unwinding some positions. Whereas in Europe, we've seen strong EBOB spreads as well. There's not too much to say. It's just been strong all round. Rubber rallying further 20 cents per barrel this morning, passing $24 a barrel for April. And the EIA stats, which came out on Friday, are pretty poor. 3 million barrel build in gasoline stocks, but
we're still running. Just
taken on the chin completely, yeah.
Well, again, I mean, the one thing you can, remember we were talking about this lead lag information, going back to that again, refinery utilization being down 7% is a pretty big deal, because it just means that ultimately it's going to be that much longer to get gasoline back to normal levels, and especially if you were booking, you're in the nature as a trader to book gasoline moving from Singapore or east and west to US. That's like a natural arbitrage flow, right? Or heads that way. If you've seen the refinery utilization be down, you're going to have that much more confidence. I'm sure the arbitrage on physical is looking quite attractive, and these kind of things help stimulate the market and to take a chance. And it really has a bullish impact on European and Asian markets in particular, and that's exactly what we've seen. So that's not overly surprising.
No.
So again, a very real impact.
Yeah, there was a similar cold freeze this time of year in 2021, where there were loads of refineries in PAD 3 taken out in the Gulf Coast. So it'll be interesting to see how much faster the refineries and the turnaround to getting back into production will be this year. So with the light ends, we've seen naphtha lifting the refinery margins as well, which we'll talk a bit more about in our trade idea.
Yeah, good segue. Just before you do, Vincent, so just want to add, when you're looking at that graph again, it is literally every single crack is performing. Every single differential relative to Brent has performed. So I think it's poignant, because you got all these scenarios going on that even us, we weren't really believing that it was going to have that much a material impact on physical, and certainly not on trader positionings. We were favouring the range-bound trade. But all these things that are going on are suggestive of breakouts, breaking out in a different momentum, and to see positive cracks across the board, I just think that's unusual enough that something material has changed. But trade idea, Vincent, hit us.
So my trade idea this week, we're looking to go short in the March NAFTA East-West for a few reasons. So of course, the East-West has widened substantially recently. Stats the difference between the Asian benchmark and the European benchmark. So it's widened substantially on the back of Red Sea geopolitical tensions, especially with the Houthis hitting a naphtha cargo from traffic over last weekend, and which has caused a spike in price action. And from our data, we've been seeing that the market has been very much getting longer in February and March. In terms of the 7-day trading split, open interest has been increasing, and there's been genuine buying in the contracts from players like trade houses in March, whereas players that have been net short seems to have stopped out in other parts of the curve. So the argument is that the short covering flows have been mostly, for the most part, completed, and at these levels, providing tensions don't escalate further, there could be a lot of profit-taking flows from recent length, as well as capacity for new shorts to come in, as well as importer hedging flows as well, especially with open interest above the 5-year average and nearing the 5-year maximum. We think that there may not necessarily really be further room for more bulls to come in.
Okay, this is a super interesting one, because I completely see your point on the stopping out. Right, you've got the price action has become very volatile, above $30 per metric ton. It looks like if we go way back, not way back, only a couple of weeks, we were quite a bit lower. Right, we've had a pretty decent rally in East-West prices, and to suddenly get this volatility spike in the last couple of days is indicative of, right, that is the pain point for the shorts that are in the market, and they've just gone, right, that's it now, just buy it all, just take the loss, take the pain. And it's the classic case scenario that at that pain point, the market can kind of see for itself, or it's gotten to the levels where that's it. And because they've stopped out, the new shorts can enter. Either they think it's a good idea speculatively, or the physical levels have opened up and you finally reached a level which it works to kind of move the physical around or whatever. So you get all these new shorts entering at that point, and that's what's so annoying about stopping out. It's like it's always when you stop out that the market comes back in your favor. But it's kind of the market dynamics. Like it's an open interest thing. Ultimately, when there's buyers, there has to be sellers, and this is what makes your argument quite interesting. But it's also quite confusing in the data, because like if we go back to the open interest graph and what you're saying about open interest, Vincent, you say it's actually growing. So it's getting towards the maximum capacity, like quite early on in the contract's life cycle, right? Usually it's not reaching this amount of risk. So there's people wanting to be short. They put a lot of risk into this contract early. As we just said, clearly the buying and the pain couldn't have been stopped by some people. I think we've got entry levels here as well, where we can say the people who have been shorting in the last 7 days, and certainly in the last 3 months and beyond, have been selling at lower levels. So they've coursed out the money and they've reached their pain point. So to your point about the market getting longer in the last 7 days, absolutely, an overall short market, for the market to be getting longer, for us to see this price action, the volatility spike, is all very indicative of a stop out. However, it's still increasing the open interest. What you expect to see is, a zero-sum game to some extent on the open interest, and then as people de-risk, which is what the data is suggesting, then the open interest goes down. But I think what's likely to be happening is it's because it's prompt, but it's still 1 month away from being prompt. You've probably got all the physical incentive traders, right? The traders who can actually profit from this on the physical side, from this derivative price, saying, no, we're actually going to hedge now, because even though we usually wait until the prompt, like these levels have opened up, we like it, we're actually going to add risk at this level. So you've got majors, you said, well, we've got banks that looking at the counterparty data who've been selling. Now banks are, by definition these days, not speculative players, right? They're taking the bilateral flow, they're financing transactions that don't go on the exchange, and they're being the sleeve onto the exchange, and that's the data we do see. The banks have been selling this, so it does show you it's highly likely that the traders that do that type of business with banks are almost all hedgers. So it clearly has reached that point where new flow has come in, and it's incentivized new hedging flow, and probably stimulated by the banks as well, saying, look, this is a great opportunity, sure you don't want to hedge. So we've actually got, more and more selling coming in and opening up new contracts. And again, this is what can be quite confusing about these niche futures, is that it actually isn't a zero-sum game because of the hedges, but also because this is just one differential, the East versus West. But traders are able to get in, they're able to, like the market makers especially, take flows from other areas of the curve to then trade this differential. So from a data point of view, the open interest goes up, but actually from a risk perspective, the market maker is just holding other contracts against the market's risk. So technically new contracts have been opened, but the risk is actually lower. So that's how that can happen, I suppose. But ultimately it does look like actually there's probably been some new speculative length, if anything, coming in that is probably yet to be washed out, because it's just that the very nature of the open interest increase. So I guess you could argue to add to it, or you were kind of alluding to it anyway, Vincent, but as we kind of get lower, and as especially if the Red Sea situation starts to sort itself out, if it does, then you've got a long way for the prices to go, and you've got some new speculative buyers, particularly from the trade houses, who will then have to sell and add kind of downward pressure. So it's a very complicated one. You picked a complicated one from a data perspective. Classic Vincent. And but it is super interesting, and I guess this is what we could have predicted when the Red Sea was kicking off. The East versus West differentials, the arbitrage differentials are going to be what's impacted, but we weren't seeing it. And all of a sudden, like this is what we're saying, the last few days, it's become very serious. Genuine impacts. I think the Iranian escalation, US soldiers genuinely being killed by what they're saying is Iran-backed militants. This is a level of escalation where it is actually believable it can come in and impact a global supply. Before you get the real tension globally with big superpowers, it never seems to have that convincing spiral effect around the corner. As you say, it's a geopolitical premium. In other words, you're kind of just putting a little bit of emphasis that it could happen. But as soon as you have this type of rhetoric and real kind of headlines, then I think the market starts to really take it seriously, and that's what we're seeing in the last couple of days. But
so with that headline, Biden vowed that US would hold all those responsible to account at a time and in a manner of our choosing. So the rhetoric is very indicative of a potential escalation and response from the US, and these are genuine. That's a genuine geopolitical risk, as with you have a major superpower being potentially involved with their troops being affected. So previously, with all of the Red Sea rhetoric, sure, there's been it's affected crude sentiment in a bullish way, but this was some genuine headline that really justified pushing crude prices and holding them above $80 per barrel.
And also, of course, the East versus West, like we're saying, and then on that nature as well, we had the actual missile attack, hit a oil tanker, so that's hitting the actual oil industry directly. Trafigura had one of its cargoes hit, and again, this is relatively insignificant in terms of the world's oil supply, but that's not what it's about. It's about the implication that it could continue to actually hit real oil supply. That's why these things are a big deal. So I guess one to watch has to be that, right? Do we see more hits on actual cargoes of oil, and is it indiscriminate? And if it continues to be, then it continues to be a situation where anything could happen.
Yeah, and moreover, how many more strikes are we going to see in Russia on their refineries? Because that's had a huge impact too this week. So I think it's just a case of really monitoring the geopolitical situation right now.
Yeah, okay. And I think just to talk about the poll we do every week, we had a US Fed cut in March question. Do we expect this or not? Pretty binary, and most 67% said no, for what it's worth. And the macro situation continues to plug along. Of course, taking a bit of a back seat to the Red Sea type of things, but it is there. So have you got anything quickly to add to that?
Yeah, the OIS curve suggesting a 53% chance of a 25% basis point cut in March. So a bit of a discrepancy. Wonder who's going to be right between the listeners.
Pretty close, actually, I would say. Yeah, and we'll leave it there. Plenty we've discussed, plenty going on in the market. This is now becoming, what we're used to. A lot of drama in markets that filter into oil, and of course a lot going on in the differentials, which is what we're trying to advocate more of, right? Just because the outright prices are doing one thing, this whole ecosystem of niche futures, 700 plus futures, they're doing crazy things, and it's all reacting to these events around the world. And that's what we're trying to educate on and provide transparency on. So please, viewers, keep listening, keep it all up. Remember to like and subscribe again, and see you again very soon for another episode. Thank you.